Okay guys, so last week we looked at what are the top 10 stocks that super investors are currently holding, as in what are the top 10 positions right now. The likes of Mohnish pubrai, Warren Buffett, Bill Ackman, Bill Gates and Steve Eisman. However, the fact that these are the largest positions by the super investors does not suggest that these stocks are currently at the best value. It could be that the position has just grown so much in size that is why it is now the super investors' largest position and why we consider them a super investor at all to begin with. And so it could be better for us as retail investors looking for investments to make today to look at the investments made in the last quarter rather than what are the 10 biggest positions. So in this top 5 list, we're going to be looking at the top 5 biggest plays by super investors by percentage of their portfolio. Rather than me explain this anymore, let's just jump into the first position on this list, Weatherford International.
At Weatherford, we are the go-to professionals of oil field services. I'm part of completion and stimulation. Producers rely on us to create the infrastructures that allow them to safely extract much-needed hydrocarbons from the earth. I think of us as super high-tech plumbers.
You're going to notice a bit of a theme in this list from the super investors. Weatherford International is an energy services company. Now, in terms of outright selling, Yatman and David Einhorn have sold far more than any other super investor has bought. However, these represent tiny portions of their portfolio, something like 2.41% and 1.35% respectively. Compare this to Atlantic Investment, who invested 13% of their portfolio into the stock, and what you get is this super investor has applied much more conviction, while the other two investors are simply trimming their portfolio. They say that in any gold rush all around the world, whether it be in America or Australia, the people that make the most money are not the people digging for gold, it's the people selling shovels. Remember this lesson because it's going to become extremely important for position number 3 on this list. In this example, oil has replaced gold and Weatherford are the shovel salesmen. Except instead of simple wooden poles with metal ends, Weatherford is selling incredibly complicated, massive scale industrial oil rigs. My first question when valuing this company is what in the flying flipping fudge happened in 2019? The company's equity just went sky high and the debt just miraculously disappeared. On top of this, really confusingly, they made more profit than they had in earnings. This is really kind of just impossible. The miracle birth in earnings proved to be no miracle at all. The company in December 2019, I believe, emerged from Chapter 11 bankruptcy filings. And so what happened to the company? What happened to the shareholders? They got diluted to owning 1% of the company. Frankly, they were lucky to be left with anything at all. And so now the question is the newly restructured company safe to invest in? Well, since the emergence from Chapter 11 bankruptcy filings, the company seems to have gotten itself back into an absurd amount of debt. Its earnings are certainly healthier, but yeah, I don't know if this company has learned lessons in the past, and I feel like it's more of a fool me once, shame on you, fool me twice, shame on me situation. I just feel like this is one of those companies where I'm like, nah, the Chapter 11 filings give me the absolute ick, and the fact that debt is starting to pile up again, yeah, this is one that I'm not even suggesting doing further research on, but if you guys do fancy doing that, by all means, go ahead and let me know what your thoughts are in the comment section. So moving swiftly on from this stock, number 4 on this list is Amazon, the big dog. Again, this stock being on this list is a little bit misleading because not only is it being bought lots, it's also being sold lots. For me, the struggle in valuing this business lies between the Amazon Web Services being the most absurdly brilliant cash king, and the North American and international business just intermittently and often losing absurd amounts of money. Amazon's ultimate goal, according to their 10K filings, is to be the most customer-centered company of all time. However, as my research suggests, this company should just be called Amazon Web Services. Ironically, the least customer-centered aspect of the business is the only and most profitable aspect of the business. Amazon Web Services made more money in 2022 than the rest of the business made in 3 years. Now sadly, half that money from 2022, half the earnings from Amazon Web Services can never go to shareholders because that has already been lost in investing in the rest of the business. In recent quarters, North America has been starting to do better, making upwards of $4 billion, which Amazon thanks for increased sales. However, due to a strengthening dollar or declining foreign currency, the international business is still losing money. All in all, it means that the only portion of Amazon I'd like to own, Amazon Web Services, is completely diluted by the North American and international side of the business, and it is ironically the least customer-focused product they have at Amazon. Anyway, that's enough of me ranting about Amazon. The company would be great in my opinion if it was at a different price. Next on the list is another crazy, outrageously priced business, Nvidia. If you do not know who Nvidia are, can I just suggest that you just go and buy index funds and maybe leave individual stocks alone. Don't get me wrong, an earnings of 10 billion is really nice. Their debt to equity is fantastic, but that does not justify a valuation that is 100 times its earnings. This is pure wild Wall Street speculation. But giving Nvidia its fair due, let's do some basic valuation on the business anyway. Nvidia is a company that manufactures graphics cards for a variety of different purposes. Nvidia had an enormously profitable gaming and GPU business, and then all of a sudden came along crypto and they started selling chips to crypto miners. This enormously boomed their sales, and then came along AI cloud computing. So massive software companies needed enormous amounts of chips all of a sudden, and Nvidia were the company apparently that could produce these super ultra performing AI chips. And they managed to scale up production incredibly fast and made an enormous profit of all 3 of these booms. But really, we should be seeing 14 billion in earnings this year, and the reason that we haven't is because while their AI business grew 4 billion in the last year, their gaming and GPU business shrunk 4 billion in the last year. So AI basically just cancelled out its gaming and GPU business. My concern with Nvidia is that, to my knowledge, the company offer no services that deliver reliable earnings. Their income really relies on them just having GPU dominance that year. Apple's dominant product to this day is the iPhone. However, that is not the dominant force of their earnings. The App Store and Apple Music and Apple TV, this is the services that generate tons of cash flows for Apple. For example, one of the main reasons that Facebook wanted to create the Vision headset was because they got frustrated with Apple changing the rules and then Facebook being screwed over. I think without income revenue like the App Store, Nvidia is going to really struggle to maintain its current position in the S&P 500. Therefore, I think there will be opportunities to buy Nvidia at a much better price. Now, number 2 and number 1 on this list are both mining companies, so rather than being the shovels, they are the gold themselves, or in this instance, coal. And so both of these companies have been bought in enormous quantities by Mohnish pubrai last quarter, and so I think there's a lot of exciting potential here. And actually, I bought stocks in these doing research for this video, so I'm going to talk about the research I did and why I bought them and why I think that coal is quite interesting right now. Console, for example, 750 million in earnings, 3 billion in market capitalization. That is a price to earnings of 4. I was wondering, how long could this possibly go on for? How long are these mines good for? On my look, when I looked at the sort of conservative estimates for how much coal they had left, it looks like these mines are good for at least another 16 years. The 2 major risk factors for this business are decreased infrastructure spending or decreased production for steel and sort of housing projects and stuff like that with rising interest rates. Another big risk is the rise in sort of what they call, I think, green steel. So steel that gets produced without using this particular type of coal. However, industry insiders seem to think that it will be slow before companies really start to adopt this green steel. Even though it's in development and it's being rapidly moved in scale, there will still be a market for coal for a few years to come. Alpha Metallurgical Resources, Alpha Metal 𝗤𝗏metallurgical Resources, another mining company, number 1 on this list, also bought by Mohnish pubrai. A lot of the same things. This company is actually cheaper, it would seem, and absolutely zero debt and more in mining reserves. Perhaps that is why Mohnish pubrai put more money into this particular coal mine. But yeah, they've got more mines, lots of reserves, and yeah, they have a market capitalization of about 3 billion and earnings last year in 1 billion. Now, their forward PE by analysts is that the company's earnings are going to go down. However, talking to people that work in the coal industry, I really went into some sort of avenues when researching for this video. That forward PE is complete and utterly useless, and a lot of people are saying that actually these companies are going to continue to make around 1 billion a year in earnings going forward. So these are really exciting opportunities, and so I just put in about 1% of my portfolio into each of these, but I might move a little bit more in as I become more confident over time. And I'm trying to reach out to a couple other YouTubers that have done tons of research on this, far more than I've done, and get them onto this channel so that you guys can get a snapshot of what the potential risk factors are. For instance, what I'd like to know is at what price does coal need to fall to before these companies are no longer making money? So I have a bit of research on that, and it's a lot harder than you might think to actually work out what that exact price is, because there are several different types of coal that can be in these mines. So each mine has coal of a different quality that sells for a different price. So it's not as simple as you might think. So yeah, I've laid out my goals for these two mines. So for Consol, as an example, I've laid out the fact that they should be producing around 25 million tons of coal per year. They should be aiming to sell that for $75 per ton and at a cost of $36 per ton, and continue to do things like share buybacks. If I continue seeing all of that, then I might pick up shares in the next couple financial quarters. Right guys, that's all from me. I hope you enjoyed this video. This is the top 5 stocks bought by super investors in the last quarter by portfolio percentage.